Sanjay Dongre, EVP and Senior Fund Manager at UTI Mutual Fund, joins us on the show right now. Sanjay, hi, afternoon. Given the way we've got a sell-off coming in on the gap up, it clearly seems like the market is fairly cautious right now and continues to be a sell-on rise.
Yeah, obviously the kind of events which is surrounding the global markets will have its impact on the Indian markets in the near term. But you have to look at Indian markets slightly from the shorter to longer term perspective. If you look at from the valuation angle, what you will find is that the Indian markets today are quoting at about 14.5 times 1 year forward multiple, which is the average valuation at which market has quoted in the last 5 years or 10 years. But what you will find is also that going forward, there are 2-3 things which are going to change in the Indian economy.
Sanjay,
which would be coming from on the, yeah.
Sanjay, the other key differentiator for Indian markets of late has been flows. The macro fundamentals are bad, the fundamental turf is not strong, earnings are not expanding, earnings are contracting, and GDP also is slowing down. So what is the case for foreigners to invest into Indian equities when the macro and micro, they both are looking poor?
No, I would slightly differ from you on these accounts. What you will find is that what I was trying to tell you is that there will be some stability which would be coming on the currency front because of the tapering of quantitative easing is most likely to get delayed in 2014, and therefore RBI is going to have enough time to mop up the foreign reserves, and therefore as and when the tapering happens, there will not be any substantial impact on the currency market. And therefore, if the currency is stable, I think that's the one positive factor which obviously FI would be looking at. Secondly, what you would find is that the last 4-5 quarters, the earnings have been declining. But when you look at the earnings which is going to get declared for the quarter ended September 30th, 2013, what you will find is that the earnings are going, for example, if I talk about, say, Sensex companies' earnings, what you would say Sensex companies' earnings is going to show maybe 5 to 7% kind of earnings growth, while it has been the -2 to 3% in the last 4-5 quarters. And the reasons are obvious. The rupee depreciation of 13% in the last 1 year obviously is going to add not only to the top line but also bottom line of some of the companies in the which are there in the Sensex or Nifty. And mind well, these are the large weightages, has a large weightage in the Sensex or Nifty has a companies which is going to get benefited because of this rupee depreciation. So on one hand, you will have the companies which are the great beneficiary of rupee depreciation, while on the other hand, you will have the companies which are operating in the domestic markets, and obviously because of the decline in the GDP growth, their earnings as well as the top lines are going to get subdued. But overall, when you look at, I think the earnings are more or less have troughed, and going forward, you could see the earnings slightly inching up, I think. And when you add to that, the valuations are not expensive, I think it makes sense to invest in the, or one should remain constructive on the equity markets from the next 2 to 3 months perspective.
Sanjay, what's the expectation then from IT? Does it seem like earnings could peak out come this quarter, or do you still see significant upside in the entire sector?
No, first, when you look at the IT sector from the valuation point of view, the valuations have risen significantly. I mean, most of the stocks which were quoting in the band of 11 to 14 times 1 year forward multiples, today those stocks have quoting between 15 to 19 times 1 year forward multiples. So valuations have inched up, but they have inched up because of the reasons. I mean, when you listen to the managements of IT companies, what you will find is that most of the IT companies are getting new deals signed going forward. Some of the large deals are coming for rebidding. The demand environment has actually improved in the US, and there is a momentum in the volume growth one could expect in the next 12 to 18 months. So if that were to be the true, I think the earnings will keep on growing, and again the cherry on the cake would be in the form of rupee depreciation. Earlier, for example, in when you look at CY12, there was a rupee depreciation, but most of the benefits were eaten away by the wage increases which IT companies had given to their employees. But when you look at next 12 months, the expectations on the wage increases are lot more subdued than what was in the past, and therefore what you would find is that the most of the benefits of rupee depreciation to come to the bottom line of these IT companies, and therefore I think when you look at the Indian markets from the next 12 months perspective, it's very unlikely that the investment cycle is going to get revived. So in the absence of that, obviously the funds are going to get positions in the defensive sectors, or where there is a good traction as far as the earnings are concerned, and therefore the IT perfectly fits that bill. And therefore when I look at the IT sector from the next 9 to 12 months perspective, I think it is going to remain favorable as far as the funds are concerned.
So Sanjay, IT currently has a 17-18% weightage on the Nifty. In the funds which you manage, what is your exposure to IT as a group?
Yeah, I had taken a good amount of positions in the month of January and March. A little bit positions were sold off after the Infosys, but I have held on to my IT positions, and today in my diversified funds I have a IT weightage about 20%.
Sanjay, good to have you on the show. Appreciate you taking the time out and joining in.